It's our first guest today, saying consumer spending unlikely to drive the next phase of U.S. growth, though. She says improvement must come from hiring and corporate investment. Joining us right now is Shannon Saccocia, Neuberger Berman's Chief Investment Officer. Good morning to you.
Thank you for having me.
So you're not so optimistic, sadly.
I would say that our concerns about the consumer are not paramount. So while we think that there's likely to be continued resilience of the consumer, we know that based on the last couple of years of spending, if we're looking for the consumer to drive trend growth the second half of this year, into 26, we're probably not going to get that.
Okay, so if we're going to get anything, who's it coming from?
So we think it needs to come from business investment. So if you saw, sort of post-election and then really through the inauguration, you saw a sharp increase in capital expenditure expectations. Companies were looking to invest in this more pro-business environment, expecting some help perhaps from the tax plan. And so we think that businesses really need to get more confident about reinvesting in their growth here in the U.S. in particular, and then hiring as a result of that.
And you think they're going to do that, or they're not going to do that?
No, I think that there's still a stage set for them to be able to do that. If you look at particularly some of the things in the tax bill, we're talking a lot about no taxes on tips. We're talking a lot about extension of personal tax cuts to offset the tariff impact. But if you look at 100% expensing, changes in depreciation, some of this, some of the more pro-business aspects of this bill, we think that combining that with a lighter regulatory touch that can drive that improvement in business sentiment. And as you know, that's significantly more important in sort of driving prospective economic activity than what the consumer says.
But we're counting on growth. We're not counting on spending cuts.
No, it's going to have to come through growth. I mean, and that's the challenge is that, if you obviously we're talking a lot about the 10-year. That's the biggest concern right now, because if you're getting this expectation that we're going to offset the upward pressure on the long end of the curve because we're going to see improved growth, there's a transmission mechanism that needs to occur there. And I think this interim period where people are worried about continued fiscal sustainability concerns, the burgeoning budget deficit, those are challenges that are pushing up the long end of the curve.
Debt to GDP, which is already, it's got to come down, has to come down, right?
Well, I mean, if you think that this catalyzes both the consumers, which again, we'll see how much of a catalyst it will be for the consumer. It needs to catalyze that growth.
When you cut at the same time, when Moody's sees some, we all know what's out there.
Well, Moody's was a little late to the game.
I know they're late.
They're very late to the game.
But at least it emphasizes $37 trillion. At least it drives that point home again.
I think that point's been driven home on several occasions over the course of the last couple of years. I mean, I don't think that there has been a lack of concern about U.S. spending. I think the concern has been, I think the offset to that has been, but we'll continue to grow this economy against the backdrop of American exceptionalism.
What I can't figure out about all of this is I would like to believe that you're right, that corporations have to, not that they have to spend, that they will spend. That's what I want to believe. I can't figure out the paralysis that both the tariffs have created and this bill, which you either believe is going to be done, very quickly by July 4th or not. And if this gets extended into sort of a Labor Day situation or post-Labor Day, I know Scott Besson says that we sort of reached the debt ceiling in August.
Has there been paralysis?
Well, there hasn't been paralysis by the consumer.
No, by corporations. There hasn't been
paralysis among the sort of big corporates, or the big tech guys have not had that paralysis.
But you think?
I think that they've been delayed. I don't, and I feel like the answer is there's a difference between, I think, longer term paralysis and I'm a corporate executive who hasn't invested in my business for the last 5 to 10 years, and why am I going to start today versus later in the year? So that's why I do think that there's a catalyst there. What I would say is that as it relates to the timing of this, I think you make an incredibly important point. June could be a difficult month, and so we've seen this divergence now between policy uncertainty and the VIX, for instance. They had been in lockstep. Now they've diverged.
Right.
No more earnings in June. We've got the Fed. We've got this pending tax bill. We've got concerns about the debt ceiling. So I do think that we're entering into a period where we've had this really nice rebound in the equity market. Longer term, still very much constructive, but this period over the next 4 to 5 weeks and watching just what we watched this morning.
New lows or not?
No, I don't think we'll hit new lows.
Because Kate last week, so Katie Sockett said new lows.
I don't think we'll hit new lows.
I mean, what a snapback we've had. Why? Did we deserve it?
Well,
Nothing's changed that much.
I think people are viewing this as a continued step down in the escalation of tensions, and I think that what has come out of the Trump administration has been a recommitment to that this is really about China, and I do think that provided a little bit more comfort.